What does leverage really mean in trading, and why is it such a hot topic? Imagine you want to buy a house that costs $300,000. Now, let's say you only have $30,000 saved up. Instead of waiting years to save up more, you take out a mortgage. The bank allows you to borrow the remaining $270,000, giving you the power to purchase that house without having to pay the full price upfront. That's leverage in a nutshell, using borrowed funds to amplify your buying power. In trading, leverage works similarly. If you have $1,000 in your trading account and your broker offers you 10 to 1 leverage, you can control $10,000 worth of assets. This means you can buy more shares or contracts than you could with just your own funds. It sounds appealing, right? More potential for profit. But here's the surprising part. Leverage isn't just a tool for magnifying gains, it also magnifies your risks. Let's break it down. If your $10,000 position rises by 10%, you'd gain an extra $1,000. But if that position falls by 10%, you could lose $1,000 too, wiping out your entire initial investment. This is where the danger lies. With leverage, even small market movements can lead to significant losses, and sometimes traders find themselves owing more than they initially invested. So, while leverage can supercharge your trading potential, it's essential to understand that it also comes with heightened risks. Grasping this balance is crucial for anyone stepping into the world of trading. Imagine you're at a car dealership. You found the perfect car priced at $20,000. But here's the catch. You only have $2,000 in your bank account. This is where leverage comes into play. Instead of saying, "I can't afford it," you go to the bank and say, "I want that car, but I need a loan for the rest." Now the bank agrees to lend you the remaining $18,000 because they see the value in that car and know it can be collateral for the loan. So you drive that car off the lot, even though you technically only put down 10% of its value. This concept is leverage, using borrowed funds to increase your buying power. But let's delve deeper. You're now responsible for repaying that $18,000 loan, along with interest. If your car's value drops, say it's suddenly worth $15,000, you could face a tough situation. If you decide to sell the car, you wouldn't just lose your initial $2,000 investment. You would also find yourself in debt. That's because you owe the bank more than what the car is worth now. And here's the surprising part. Leverage amplifies both gains and losses. If the car's value increases to $25,000, you could sell it, pay off your loan, and pocket a nice profit. But if it drops, your losses are magnified too. This risk-return dynamic is what makes leverage so powerful, yet potentially dangerous. It's the double-edged sword of finance. Great rewards, but equally great risks. So leverage can seem like a ticket to bigger purchases, but remember, it can just as easily lead you into deeper financial waters. Understanding how it works is the first step to using it wisely, or avoiding it altogether. Imagine you're at an auction and you spot a painting you really want. You only have $1,000 in your pocket, but the auctioneer tells you, "No problem, with my special bidding card, you can bid for 10 times that amount." So you confidently raise your paddle, now effectively wielding $10,000 to buy that painting. Now, let's break this down. When your broker offers you 10 to 1 leverage, it means for every dollar you invest, you can control $10 worth of assets. Sounds great, right? With your $1,000, you could potentially buy stocks or cryptocurrencies worth $10,000. If the value of those assets goes up by 10%, you've made $1,000, doubling your original investment. But here's the catch. While leverage can amplify your gains, it can also amplify your losses. If the value of that painting drops by just 10%, now worth $9,000, you still owe the full $10,000 you leveraged. You've lost $1,000, wiping out your entire initial investment. Many traders get drawn in by the prospect of quick, huge returns, but they often overlook this downside. The risk of leverage isn't just in your potential gains, it's equally in your potential losses. And here's the surprising part. This can happen very quickly, sometimes in moments, leading to what's called a margin call, where you may have to add more funds to your account to keep your positions open. Understanding how leverage really works, both the upside and the downside, is crucial for anyone thinking about trading. It's not just about the potential for large profits. It's about navigating the risks that come along for the ride. Leverage sounds exciting, but what does it really mean when things don't go your way? Imagine you're on a seesaw at the playground. When you're at the top, everything feels exhilarating. You're flying high, and that's what leverage does for your profits. It lets your money work harder for you. But if the seesaw tips the other way, you're not just coming down gently. You could crash hard. Here's how it works. Let's say you decide to trade with 10 times leverage. If you invest $1,000, that's like controlling $10,000 worth of an asset. If the market moves in your favor and the asset's price increases by 10%, your $10,000 becomes $11,000. After paying back your broker, you walk away with a profit of $1,000, a 100% return on your initial investment. Sounds great, right? But here's the surprising part. Leverage can amplify your losses just as quickly. If that same asset drops by 10%, your $10,000 is now worth only $9,000. After you repay the broker, you've lost your entire $1,000 investment. In some cases, if the losses exceed your initial investment, you could even end up owing money to your broker. To put it another way, think of leverage like a high-octane fuel for your trading vehicle. It can speed you up, but if you're not careful, you might lose control and crash. The thrill of leverage can quickly turn into a financial wreck if the market shifts against you. Understanding the double-edged nature of leverage is crucial for anyone considering using it. It can magnify both profits and losses, so tread carefully. And remember, the more you know about how leverage works, the better equipped you are to navigate the markets. What happens when leverage goes wrong in real life? Let's break it down with a concrete example. Imagine a trader, Sarah, who's feeling confident about a tech stock she believes will soar. To amplify her potential gains, she decides to use 50-to-1 leverage. This means for every dollar she puts into the trade, she can control $50 worth of stock. So, if she invests $1,000, she can actually buy $50,000 worth of shares. But here's the catch. Markets can be unpredictable. Let's say the stock doesn't take off as Sarah expected, and instead drops by just 2%. On the surface, that seems minor, right? But here's where leverage reveals its dark side. A 2% decline on that $50,000 investment means a $1,000 loss. That's the entire amount Sarah initially invested. She's now facing a margin call, which is a demand from her broker to add more funds to her account or risk having her position closed. Essentially, she can lose everything in a matter of moments. It's like borrowing a really powerful tool. It can do amazing things, but if you aren't careful, it can also backfire spectacularly. And here's the surprising part. This isn't just a theoretical scenario. Traders often underestimate how quickly a small move in the market can wipe out their capital. While leverage can magnify profits, it can also amplify losses, leading to devastating consequences. So understanding the mechanics of leverage is crucial before jumping in. Now think about this. Could you handle the stress of a margin call? Or do you see how easily the tides can turn in trading? Understanding leverage isn't just knowing how to use it, but also being aware of the risks involved. If you're curious about how to navigate these waters safely, hit that subscribe button for more insights. What does leverage really mean for your investments? It can create a false sense of security that transforms small amounts of money into seemingly massive opportunities. Imagine this. You have $1,000 to invest, and you leverage it 10 times. Now you're controlling $10,000 worth of assets. On the surface, it sounds fantastic, right? A small change in the market could lead to a significant profit. But here's the catch. The same small change can lead to devastating losses. When you employ leverage, you're essentially borrowing money to amplify your potential gains. But remember this, the higher the leverage, the higher the risk. It's akin to walking a tightrope with a dusty wind. A little sway in the market can bring you crashing down. If the market moves against you, that $10,000 position can quickly turn into a loss that wipes out not just your initial investment, but can put you in debt too. Let's take a quick example. If the value of your investment drops just 10%, with no leverage, you'd lose $100. But with 10 times leverage, that same 10% drop means a $1,000 loss. Your entire initial investment is gone, and you're left with nothing. It's crucial to understand that while leverage may seem like a ticket to quick wealth, it can just as easily lead to financial peril. Being aware of these risks can keep you safer in the markets. So, next time you consider using leverage, think twice and make sure you know exactly what you're getting into. Remember that what looks like a big opportunity can also carry the heaviest of pitfalls. If you found this insight helpful and want to dive deeper into market concepts, you know what to do.